All right, let's get right into it. We're about to crack open a pretty fascinating dossier on a tech company that, on the surface, looks like it's firing on all cylinders. But when you dig just a little bit deeper, you find this mysterious caution from Wall Street. It's a classic business puzzle, and we are going to piece it all together. So here's the big question we're tackling today. How can a company report absolutely fantastic numbers? I mean, beating expectations, showing strong growth, but still end up with what feels like a warning label attached? That's the contradiction we're going to unravel right now.
And the company at the heart of all this is Nutanix, a major player in the world of cloud computing. Now, they just reported what really should have been a victory lap of a quarter, but instead, their stock kind of stumbled. So let's break down exactly why their success is being met with, well, a little bit of skepticism. First up, let's look at all the good stuff, all the reasons for optimism. We'll call this the bull case. The evidence here points to a really healthy, growing, and profitable company. And to see why, we need to get familiar with a couple of key metrics that investors watch like a hawk.
First is ARR, or annual recurring revenue. Now, for a subscription software company like Nutanix, this is basically the holy grail. It's the predictable, stable income they can count on year after year, and it gives you a really clear pulse on the health of their core business.
And wow, Nutanix's ARR is looking very healthy, coming in at $2.28 billion. But here's the really impressive part, right? That number is up 18% from last year. That's a super powerful sign that more customers are signing on, and just as important, they're sticking around.
Okay, next, let's talk about how profitable they are. This 88% number, that's their non-GAAP gross margin. Now, I know non-GAAP is a bit of jargon, but in simple terms, it means for every dollar of software they sell, they get to keep 88 cents to cover all their other costs. That is an incredibly high margin, and it proves their core product is pretty much a cash machine. The second key term you've got to know is free cash flow, or FCF. Think of this as the actual cash a company has left over after paying all its bills and investing in itself. It's a true, honest-to-goodness indicator of financial health. And get this, Nutanix generated over $174 million in free cash flow in just the last quarter. This isn't some accounting trick. It's real, spendable cash they can use to innovate, to invest, whatever they want. It is a huge sign of their financial stability. And the good news didn't stop there. They felt so confident, they actually raised their cash flow forecast for the whole year to over $800 million, all while building out these key partnerships with giants like Microsoft and Dell. So by all these measures, the bull case looks totally rock solid, which makes this next part even more confusing. Okay, so now let's flip the dossier to the other side, the bear case. This is where we uncover the real reason for all that caution, despite the strong numbers we just walked through. And here's the twist. The market isn't worried about the quarter that just ended. Not at all. It's worried about what the company said is coming next. The concern is all about the future, specifically their forecast for the 2026 fiscal year. This right here is the problem in a nutshell. Analysts on Wall Street, they were expecting revenue of about $2.92 billion, but Nutanix came out with guidance that maxed out at $2.86 billion. Now, that gap might seem small to you and me, but it was enough to set off major alarm bells for investors who were just laser-focused on growth.
This quote from our source material really sums it up perfectly. Yeah, the company is still growing at a solid mid-teens rate, but for a company that's valued for its high growth, solid can sometimes feel like a major slowdown. And that disappointment, that is the core of the bear case.
So why does one forecast cause so much drama? Well, it signals that their explosive growth might be cooling off, and that puts their high valuation under a microscope. Their PE ratio is around 89, which basically means investors are paying a huge premium for the stock because they expect super fast future growth. If that growth slows, that premium price tag becomes much, much harder to justify, especially with tough competition out there. So we have a strong bull case based on performance and a pretty compelling bear case based on future guidance. How do we put it all together? Well, let's turn to the final section of the dossier, the analyst's verdict.
This table really lays out the different futures investors are betting on. The base case, the most likely path, is that the company just meets its new lower guidance. The optimistic bull case is they actually over-deliver, maybe if those big partnerships pay off faster than expected. But then there's the bear scenario, a 30% chance that growth slows down even more. You can see the tightrope that investors are walking with this stock right now.
So let's boil it all down. The strengths are undeniable. Fantastic margins, a solid subscription base, and growing cash flow. But the risks are just as clear. The threat of slowing growth, a valuation that pretty much demands perfection, and some very tough competition.
And this brings us to the final verdict from the dossier. Nutanix is a fundamentally solid company. It's profitable, it has a great business model, but it has now officially entered a prove-it phase. It has to prove to the market that it can keep that growth going and live up to its high valuation.
So, this is the final question we're left with. Is this just a temporary speed bump in a long-term growth story, or is this guidance a warning shot, a sign that the competition is heating up and the days of easy hypergrowth are over? For Nutanix, and for anyone watching them, that is the billion-dollar question.